So last Wednesday, the Fed announced that they intend to keep interest rates high longer than expected, and the market sold off. In fact, the market is now down the biggest it's been for the last 6 months, and the US S&P 500 is down 6% from its highs. So did the Fed just kill this bull market? Well, let's find out in this video. So did the Fed just kill this bull market, or is this just merely a healthy pullback in this bull market? So where do we go in the short term, the medium term, and the long term? These are questions on people's minds. So let's take a look at the markets from both a technical perspective and then a macro fundamental perspective. Now again, remember, no one can predict exactly where the market is going to go in the short term because there are too many moving parts. All we can do is to take a look at probabilities based on technical analysis and historical statistics. That's the best we can do. So let's start by looking at the charts. What do the charts tell us? So we made a pullback in August and we made a low over there in August, and it looked like we were bouncing off towards the end of August. And I did expect September to be a bullish month. Well, September is not over yet, so it may still be bullish, a few more days to go, but it doesn't look that way so far. But we'll see how it goes. So it bounced off, and then of course we had the Fed that just came out on Wednesday, scaring people. I'm gonna keep interest rates really high, all right? And the market sold off again, okay? So now we are down slightly below the August low over here, okay? So where do we go from here? Now, the first thing is to ask yourself this question: what is the trend right now? So ultimately, the trend is your friend. So if you look at the short-term trend, the short-term trend is now down. So how do we know the short-term trend is down? We look at the short-term moving averages, namely the 20 and 40 exponential moving average. So you can see the 20 EMA, the red dotted line, has crossed below the blue dotted line. So this indicates that the short-term trend is now down, which means in the very short term, in the next few days or maybe even a week, yeah, prices may still weaken. It may, okay? But having said that, you can see that the market is currently at a level of support over here, which was the previous swing low in August. So you never know, this may be what we call a bear trap. We never know until it plays out. So a bear trap is when the market looks like it's breaking below the August lows, and then a lot of bears start shorting, but then the market closes with a strong bullish candle. So we got to see whether that happens. So if the market can close with a strong bullish candle over here, that is what we call a double bottom bear trap, and that could of course push the markets higher in October, November, and then December, right? So we've got to watch that level. However, if the market cannot close back above this level next week and it continues to weaken, then yes, it could go low in the short term, because again, the short-term trend is now down based on those 20-40 EMA moving averages. But for now at least, the bull market is still very much intact. Okay, why? Well, the first thing is from the top to the bottom, it's a 6% decline. That's nothing. That's not even a correction. Remember that anything less than 10% is just a healthy pullback. Between 10% drop to 20%, that's a correction, which is pretty normal, happens at least once a year, right? And anything more than 20% drop, then that is a bear market. So we are far away from that. We are still in pullback territory. We're not even in correction territory yet. So don't piss your pants just yet for the bulls, okay? Now at the same time, if you take a look at the moving averages, you can see that our 50 moving average is still above our 150 moving average. As long as the 50 is above the 150, the medium-term trend is still intact. It's still an uptrend on the medium term. And of course, the 200-day moving average, the price is still above the 200-day, which means the longer-term trend is still intact. So again, based on that, short-term trend down, we may weaken in the short term, but medium to longer-term trend still up. Bull market still very much in force. Now also look at historical statistics. We are right now in the 11th month of this bull market that started in October last year. And historically, bull markets, cyclical bull markets, last on average 5.5 years. So 11 months into the bull market, historically, statistically, we've got at least 4.5 years more for this cyclical bull market. But I did mention before that this is not just a cyclical bull market, it is a secular multi-business cycle bull market driven by AI and automation, which I do expect to run for at least the next 10 years, right? I've said that many times before. So that is my view. Again, I could be wrong. I'm basing on history, statistics, but we have to look at what's actually going to happen in the markets, right? Now, so if we continue going down, if we can't close back above this swing low, how much lower can we go? Again, it's really hard to predict the exact bottom, but we can guess. So I'm guessing, let's look at the weekly candles on the S&P 500, okay? So where's the next level of support? You can see that if we take our drawing tool over here, I could see a level of support somewhere about there, okay? Why? So this is the previous swing high that became resistance, and remember that resistance, after broken, becomes potential support, okay? So at the same time, this coincides with the 150 and the 50-day moving average on weekly candles. So this level here, 4169, is a pretty strong level of support. So if we break that level and we don't get that, bear trap rebound pattern, then we could see another 3% drop in the next 1 or 2 weeks to this level over here, 4169. Now, if you zoom the chart out a bit, you can see that if you take a trend line and you kind of like draw the trend line from the low of the COVID crash to the low of the bear market last year, we do get a bit of a trend line support as well over there. Okay, so that fits in pretty nicely, all right? So that was the COVID low, that was the bear market low, and then we had this test over here. And again, interestingly, this actually coincides with 4169 as well. So like I said, this is a pretty strong level of support. And if we do get to this level, from the top to this level, that would be roughly about a 9% decline from the top, which again is not even a correction. A correction is at least 10%. So for now, the bull market looks like it's still pretty much intact. Next, let's take a look at history statistics. What does it tell us is going to happen in the next 4 months of the year? So from January to July, we had the market up more than 10%, and then August was a bearish month, and then September looks like it's going to be a bit bearish as well. So typically we know that August and September are the weakest months of the year, and the last quarter tends to be extremely bullish. Now, going back to 1938, history shows that when January to July is bullish, that means it's up more than 10%, and you get an August which is bearish, what happens from September to the end of the year? Well, it tends to be bullish. Again, this is based on historical statistics. And you can see these were all the years when that happened: 1938, 54, 55, 64, 67. So again, this is from January to July when the market was up more than 10%. You had August, which was a bearish month. And this is what happened for the rest of the year. From September to the end of the year, the market was up. Out of all these instances, it was up 100% of the time with an average mean gain of 9.9% and a median gain of 8.7%. So if history is anything to go by, then we've got a 100% probability that we're going to end up with a gain in the next 4 months. Now again, there's no guarantees in the market. This is just based on the sample of similar years in the past. Okay, so now let's take a look at it from the macro fundamental perspective. What caused the sell-off, and will it continue to cause more sell-off? Yeah. So what happened on Wednesday was the Fed came out, and as expected, they held their interest rates at 5.25% and 5.5% range. Now, they did say two new things. Number one, they did say, hey, we may raise rates one more time by the end of the year. Now, I doubt that's going to happen. I think that they have already finished their interest rate hike cycle. I don't think they're going to raise rates anymore. In fact, if you take a look at this Fed Watch tool, this tool also calls bullshit, right? So if you take a look at this tool, you can see that for the next meeting in November, on November 1st, the probability of them raising rates again is 26%, okay? And the last meeting of the year, which is December, the probability of them raising rates is 38.4%. So another rate hike by the end of the year is not really an issue. I don't think the market buys that. But I think what the market is freaked out about is that the Fed indicated that they're not going to cut rates as much as people expected next year. So let's take a look at the Fed dot plot. We call this a dot plot. So in the Federal Reserve, they've got a lot of members and they all kind of like vote where they think the interest rate will be by the end of this year, 2024, 2025, and so on and so forth. So all these dots you see are the votes of the members, okay? So you can see that this year is pretty much like done, right? Right now we are at this 5.25%, 5.5% level. So the question is, where are rates going to be next year, okay? So now back in June, the market expected the Fed to cut interest rates next year down to 4.6%. But now the Fed is coming up and saying, we're not going to do that. We're only going to cut rates twice next year by 25 basis points each. And we're going to keep the rates at 5.1% to the end of next year. So this was what made the market freaked out. Oh my God, rates are going to be so high for so long, we're going to die. Ah! Now, before you panic like everyone else, there are two things you have to understand. Number one, the Fed themselves are terrible at forecasting their own interest rates in the next 1 month, 6 months, or 12 months. Most of the time, whatever they say they're going to do, they never do it. Or they do what they say they won't do, right? So, for example, last year, or the year before, if you recall, on December 2021, when interest rates were near zero, okay, the Federal Reserve Chairman said his forecast for the next year was that he will raise rates 3 times by 25 basis points to below 1%. That's what he said. I'm going to raise rates to 1% next year. But what did he do the next year? The next year, he raised rates 7 times to 4.25%, 4.5%. So the Fed has a terrible track record for predicting their own rates, which they are raising. So if the Fed themselves can't predict their own rates, then how can we predict their rates, right? So that's the first thing to understand, that whatever they're saying, they may not even do. Now, even if they do it and they keep rates at 5% for the whole of next year, will that kill the market? Will a 5% rate kill the stock market? Historically, no. Now remember that what is causing the market to freak out, especially a lot of tech stocks to drop recently, is not the Fed funds rate itself. It is how the Fed funds rate is influencing the longer rate, which is the 2-year and 10-year Treasury rate. So the last few days, we had the 10-year Treasury rate really rallying and then going above the high made in September. So this is what is freaking the market out. Now, I myself am pretty surprised by this because I thought that the 10-year rate had peaked in late of last year, and I thought that we're not going to go above that. Now, I was wrong on this. Sure enough, the rate is now higher than where we are right now. So again, when the long-term Treasury rate goes up, people think that, oh my God, the economy can't take it, the economy is going to collapse, and the stock market at this rate is overvalued, the market will collapse because it can't handle these high long-term Treasury rates. So is that really true? Well, let's take a look at history and let's see at a 10-year rate of 4%, and even if it goes to 5%, can the market actually handle this high 10-year rate? So what's interesting is this piece of research that was done by Fundstrat. And what they found is that since 1930, they compared the PE ratio of the S&P 500, which is the y-axis, with the 10-year Treasury rate on the x-axis. So what they found was pretty interesting. The PE ratio of the S&P 500 is actually the highest when the 10-year rate is between 3.5% and 5.5%. That is the best place to be to get the highest valuation for the S&P 500. And where are we right now? Right now, the 10-year rate is at about 4.3%, right at the center. We are at the sweet spot, okay? Now, even if the 10-year rate continues going up a bit more to 5.5%, it doesn't mean the market will drop, because again, historically, that is when the S&P 500 has the highest PE valuation at about 20 times earnings. So where's the PE ratio of the market today? Are we at 20 times earnings? We're about there. So I showed this chart a few days ago. Let me show it again. If you look at the current PE ratio of the S&P 500, it is now selling at 22 times earnings. Now, this is based on a few days ago. Now that the market has come down a bit more, I suspect we are now at about 21 times earnings, right? Which is roughly about 20 times earnings. So in other words, the market is fairly priced at the current 10-year interest rate level. But I did mention before that this 20 times earnings has been distorted by the Magnificent Seven stocks, which are Nvidia, Tesla, Meta, Amazon, Google, Microsoft, Apple. These 7 stocks have a relatively higher PE ratio of about 20, 30 times, Nvidia like 80 times earnings, if I'm not wrong, right? And they deserve it because these companies are showing huge earnings growth. So they deserve the high valuation. But their high PE is kind of like skewing the entire S&P 500 PE upwards. So while these stocks are up 100% this year, the rest of the S&P 500 is only up 4% this year. Okay, so most of the market is actually at a low PE. So if you exclude the Magnificent Seven, the S&P 500 equal weight ETF, where it doesn't get skewed by these 7 stocks, is only at 16.84 times earnings. And again, this was a few days ago. If you take into account the recent drop in the market, again, we could be actually closer to 16 times or even 15 plus times earnings. And 15, 16 times earnings is actually undervalued based on the 10-year Treasury rate of 3.5 to 5.5%. So to answer the question, is the market expensive? It doesn't seem so right now. And sure enough, if you take a look at individual companies, individual stocks, and do an intrinsic value analysis, you will find that there are many high-quality stocks that are selling at a discount right now. So I've actually been buying stocks, and so have people in my community. We are taking advantage of these undervalued levels in some high-quality stocks. So in a nutshell, the US markets are not expensive based on current 10-year Treasury rate levels. But then some people would then say, but Adam, the markets could still go down, it could still crash because of a lot of problems that are cracking the economy. You've got the UAW strikes, the government shutdown, all prices keep going up, that could create inflation again, that could sap the consumer spending. Yes, it could happen. Of course it could happen, right? But let's take a look at each of these individually. First, the government shutdown again. This is a perpetual issue that keeps coming out. And people keep thinking if the government shuts down, market's going to crash. And again, historically, no, the US government shutdown, even if it shuts down for a few days, it doesn't really affect the market. So again, if you go back and look at history, you can see that these were all the government shutdowns from 1981 to the last shutdown in 2018 to 2019. In fact, the last shutdown was the longest shutdown where the government was shut for 34 days. And what happened to the S&P 500? It went up 9.3%. So to me, this is not an issue. Shut it down. Who the hell cares? No, actually, it is important they remain open. But in terms of the market, it's not really significant, right? Now, how about oil prices? Yeah, oil prices have been going up again. And people are now saying if oil prices go up, inflation will flare up again. The Fed will then have to raise rates again to bring inflation down. Now, remember that the Fed looks at core PCE and core CPI that excludes food and energy, because the Fed knows that, yes, high energy prices creates inflation, but they have got no control over energy prices. Raising interest rates doesn't bring down energy prices. So the Fed does not take into account higher oil prices in deciding whether to raise interest rates. But yes, I do agree that higher oil prices may cause consumers to pull back their spending, because if they spend a lot on oil, then they can't spend on other stuff. And that could, of course, create a drop in the economy. It is possible. That's one argument. But the other argument is that oil prices are high because of more demand, and more demand is because of higher consumer spending, right? So there's always this paradox. So what's the correlation between oil prices and the S&P 500? Surprisingly, it is actually positively correlated most of the time. In other words, most of the time, if you look at history, when oil prices go up, the S&P actually goes up, right? Don't ask me why. Well, it's just like that, right? So you can see, now it's not a perfect correlation, of course. You can see that over here, you can see in orange, oil prices go down, S&P goes up. Can you see that? Oil price goes up, S&P goes up. Oil price goes down, S&P goes down. Oil price goes sideways, S&P goes up. Oil price goes down, S&P goes down. Oil price goes up, S&P goes up. Oil price goes down, S&P goes down. Oil price goes up, S&P goes up. Now, of course, it is not a causal factor. It's not that oil price goes up causes S&P to goes up. No, it is just a relationship, right? And most of the time, not all, it tends to be a positive relationship. So I wouldn't worry too much about oil prices going up. Of course, if it goes up to like $200 a barrel, then of course, oh my God, right? But right now, it is still within manageable levels. So in summary, the stock market is still in a bull market. We are down 6%. We could still go lower in the short term, down to 9%, and that's still within a pullback. It's not even a correction. Yeah. And remember, in a bull market, the bull climbs a wall of worry. There are so many things to worry about, but as long as the bull market remains intact, we should still go high over the medium to long term. Okay. Now, of course, there is another big concern people have that, what if we do get the recession next year? Because the Fed, they keep rates so high, and that will cause the monetary policy to be too tight, and that could trigger a recession, especially now that the yield curve is super duper inverted. And historically, that has caused a recession. Yes, I agree, that may happen. So how can we prepare for a coming recession next year if it does happen? And what does this inverted yield curve mean? There's a lot more to discuss, so I'll do that in my next video. So if you want to catch my next video, subscribe, and I'll see you guys soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.